want Fusion to be the BlackRock Aladdin of DeFi, where you'll have TradFi guys come in. But Fusion and its Fuse system actually does multiple things like that. It coordinates the markets.
And you had all of these swap fees, and now you have a lot of vaults where it's just USDC in, USDC out. From a depositor's perspective, it is super comfortable because I would rather be willing to take a bit of a lower yield in exchange for certainty that I do not face any costs before or after the fact.
On a lot of the leverage looping vaults, let's take you through one a little bit later. You can see in the back end or at the vault level what's possible and what's not. What assets, what actions in which markets are whitelisted by the curators.
Welcome back to episode 43 of the Odyssey podcast. Today we are joined by Darren, who's the co-founder of iPor and iPor Fusion, and we will dive into everything surrounding vault infrastructure, vault curators, and everything you need to know when you are an active vault depositor. Darren, thanks a lot for joining. How are you doing?
Yeah, I'm good. How about you? I'm actually sad to not be number 42.
Why that?
Life, the universe,
Is it a special number?
Douglas Adams.
You missed it by one episode. Maybe let's get started by elaborating a little bit on how iPor came about and how it evolved. Like, what was the original idea? I'm pretty sure I remember you guys from a few years ago when you were still doing something else than vaults. You were doing like some interest rate swaps, if I remember correctly. So if you could shed some light for the audience on how iPor emerged and evolved over time, I think that would be pretty cool.
Yeah, so according to the audience, I'll try to go really quickly. I think some people know us from iPor, the derivative side. So if we break down everything in DeFi, everything is rates, right? And this is the position that we took when we first built the iPor protocol. So iPor stands for Interprotocol Overblock Rate, or a hat tip to the LIBOR, which is the former benchmark rate that underpinned under 350 trillion in debt deals and derivatives. So it's the idea that, the market needs one consolidated benchmark rate, and then people can trade that rate for different rates strategies. And this is a very popular thing in TradFi. It's about 700 trillion notional, 650 annually, which is the largest derivative market in the world. Rates are a big thing. So we started with that because effectively, if you think of rates and their derivatives, they underpin anything from talking about like the pension systems to bank balance sheets to the retail mortgage, right? So taking a derivative allows someone to create something like a fixed rate out of a floating rate. So if you think of let's just look at like Aave, you have this rate curve that goes up and down. And you can control your rate by taking a derivative of that. You can either take exposure with leverage as the rate's going up or as the rate's going down. As the rate's going up, we call this pay fixed, and as the rate's going down, receive fixed. So we started with this derivative, which is really implicit of efficient market, a mature market. And it's probably something that is way too early for its time. We found that out, where we had a lot of people had a very hard time understanding what, kind of these interest rate derivatives do. But you take something like Pindle, which is more like a zero coupon bond market, and people understand it as kind of the short-term lending instrument, fixed lending instrument. It's not so useful for borrowers, but much more useful for lenders. And it tells you, it's a derivative on a rate, right? So it has a payoff more like a bond coupon. So we started with that. And, we've traded about 5 billion in notional interest rate swaps over over the lifetime of the protocol. But a lot of people have very difficult time understanding it. And also, rates are fragmented. We see actually in this cycle, let's say if we take the cycle starting in 2024, very different from the 2020 cycle, where you actually have the best DeFi builders are coming in the credit market side, right? So it was always just Aave and Compound, and then Morpho came in with the optimizers, and then Morpho built their own credit market. Euler came out, Fluid came out. You have some other kind of Silo, Ajna, all these really kind of innovations and derivations of credit markets. But what you get is rate fragmentation and you get rate volatility because you have the same kind of pool of capital going against, in multiple places. So if we go back to that first idea that, like a benchmark rate is useful when you have a mature market. Actually, we don't have a mature market and we don't have market efficiency engine. And part of that's why we built Fusion. So the original iPor protocol, which is still running and will continue to run, and we have a V3 in the works. You have someone who puts up, you have a peer-to-pool model where the pool puts, let's say, USDC. That becomes the balance sheet of the decentralized investment bank. It underwrites a portfolio of derivatives, both pay and receive fixed across multiple tenors, and it deploys capital to the money markets. So this deployment of capital to the money markets is your basic money market construction. So, long story short, in there, we built a very concrete type of construction to begin with. In the V2 of the iPor derivatives protocol, we started using Diamond Proxy, and we always wanted to upgrade a couple parts of our system. One was actually the asset management, and two was creating a one-click structured product suite. And that ended up being Fusion, which is spun off, and it's entirely its own protocol, still connected to the iPor protocol. Both products give to the same DAO treasury, but that's really what you see getting a lot of adoption right now.
Maybe to dive deeper into your original vision, just really quickly, how does that kind of overnight or overblock rate form? Is it essentially you take the base of DeFi lending protocols like Aave and these rates, and you are willing to take on a discount on these lending rates in return for getting a fixed rate, so a yield guarantee, or how do the underlying mechanics work?
You can think of it as a yield guarantee. So the issue with the DeFi markets, like, if you're in TradFi, one of the most interesting kind of data points for you is called the 2 and 20 curve, which you're looking at, what these instruments are priced 2 years and 10 years. But in DeFi, we don't know what our credit's worth tomorrow, right? So this is something, as a borrower, as a lender, you can't tell me with certainty what the Aave rate of USDC for borrowing is going to be tomorrow or the next block, right? So an interest rate swap is really a derivative of that type of instrument. And so we started with the USDC index, which is a benchmark weighted index between Aave and compound V3s. But in the V3 of the iPor AMM, we'll be able to underwrite the USDC rate of borrowing, the USDC rate of lending on Aave, the iPor index rate, and also the iPor USDC optimizer rate. So you'll have basically one pool with 4 different derivatives. So what most people are interested in is that Aave USDC borrowing rate on the V3, right? So let's take an example of you want to do a short-term trade. You may not really be that sensitive to the rates, right? And most people are not, at least if they're thinking very short term. That rate can spike, it can drop, and you're paying that annualized. But let's say you're taking a very kind of long-term view, or you're taking a longer-term instrument. Let's say you're doing like leverage looping. And here's an upcoming kind of teaser. So Fusion will have a leverage looping vault for Syrup USDC. More
I
details
like
about that will
syrup a
drop
lot.
later, but yeah,
Big
that's going to
maple
be
syrup holder.
a very nice one, I think. So, for example, Syrup is it's grown massive, or Maple, it's grown massively this past year. So, how that will work is it will be a leverage looping on Aave once it's accepted as collateral, which we saw it go live on Plasma, I think just today, across Morpho and across the Morpho PT market, and that will be curated by MEV Capital. So on this looping on Aave, what you're really doing is forming the basis between the USDC borrow rate and the Aave rate, right? So right now, it's about 5.6, I think, right? So if you're not sensitive to that rate, you can just leave it and farm the basis. But what happens if it goes higher, due to utilization? How long are you willing to keep that? There's always a cost to get levered up or levered down, because you have to take a flash loan, you have to swap between 2 assets. So if you were, and because of that kind of leverage position, you need to hold this position multiple months. Otherwise, you'll never recoup that cost of levering up and levering down. So you would take a swap to basically hedge that rate. So for example, if you take a pay fixed swap here, If the rate rises, that means that the basis is going to close on your leveraged loop, but you're going to be winning on the derivative instrument. So that effectively gives you more of a fixed rate experience on that borrow cost. And so that's where, if we take this example, this is where the iPor derivative AMM-v3, the AAVE3 borrow rate swap, and the structured products like this, syrup USDC looping all come into play. And this is where you see like Fusion being like a Trojan horse for interest rate swaps. It's just taken in a single click. As a depositor, you don't need to worry about it. You just go to the Fusion page, or you go to Maple's or MEB's site. You do one click, or you zap in through some other means, and all the infrastructure takes care of it for you. So you get this one click, a nice simple product, but inside you get all of kind of the risk management and the tools to fix these yields for the long term.
So all the things you're doing on the vault infrastructure provider side, specifically with iPor Fusion right now, did this idea emerge out of your original plans, or were you approaching it more from a perspective, okay, a lot of attention, a lot of capital is like running around in the vault curator, infra provider, vault manager, vault risk manager space right now? And was it more of an opportunistic decision, or did it kind of emerge organically out of your original vision?
It wasn't opportunistic, and all of the this vaultification of the world, it's now a hot narrative, but we never got into it because we wanted to build vaults. And I think what I see from a lot of players is they're getting into it because they want to build vaults, and they're like, they don't know how to build vaults, and they use the 4626 standard and they push composability, but it's really not. 4626 vaults are composable with one within another to a point, and then if you have to use anything else, then it's not so straightforward. So we really built Fusion, like I think I mentioned at the beginning, for our own needs, right? We wanted to upgrade our own asset management, and we wanted to create this one-click product. So if we take like, in the beginning, let's say the asset management inside of the AMM was stupidly simple. Deposit to the highest rate and withdraw from the lowest rate of Aave V2 and Compound V2. And this would be like kind of the infrastructure of the 2020, 2021 vein. So that like the original Yearn, if we look at like Enzyme or something like that, it's more kind of this type of technology.
Forgotten names I haven't heard in years.
But I mean, they're still around, right? You have also like Yearn V3. So if you look at kind of this type of technology, it really takes a lot of work, manual work. And if you think of it, this is replicated work inside of every asset manager that uses it, which is every time you need to add a new connector, you have to build it. So that's a Solidity engineer salary. It's a trust basis. And every time you need to change a connection, you have to upgrade the Vault smart contract and or touch the storage. So that's a hugely manual process. It's something that it's also a huge potential security risk and potential red flag if you're a depositor. So every time, you make a change, you either have to say, okay, migrate to this vault, or you just upgrade it and everyone says, okay, did you just rug me? You can't expect every depositor to understand what's happening in the very fine details of Solidity code. So we actually went through this because we had to, for example, on the DAI pool, we had to add the DSR, create a new contract upgrade, and create a new connector, upgrade the smart contract. We had to move from the Aave and Compound V2s to V3s, remove the old connector, add the new connector, upgrade. And looking at that from my own personal perspective, I don't want to touch that. I want trust minimized, don't trust, verify technology. That's part of our ethos. So we faced a lot of these problems with a very old legacy tech. And we also got a really key piece that was core to building Fusion using the Diamond proxy. And in short, Diamond proxy plays with moving routing and storage outside of the vault. So the Diamond proxy is what kind of sits behind this Fuse system in Fusion. And it's very different. So let me explain a little bit first. If we look at something like the Merkle proofs, this would be like Sommelier or something like Veda or Machina. So you have this kind of gated system which controls, what can and can't be done. If you talk about Veda, they call it the boring vault, but the boring vault is a very bad name because it's not boring. Actually, this vault can do anything. It's just gated by the Merkle proof, which is you have the construction of the calls on a side chain, but this process is extremely opaque to depositors. It's also opaque to the curators. And from what I've heard from kind of intelligence in the market is that you're sitting in a queue behind the discretionary asset managers that run these protocols. So for example, in the case of Veda, it's 7Cs. In the case of Machina, it's Dialectic. And both of these teams are top. They're top notch. They've been managing funds on chain, for multiple years and very large sums. So all power to them, but you have a different kind of potential conflict of interest.
Yeah.
So if you're a curator, one, you have to give your assets, you have to give your strategy, and you have to give your feed generation to what's probably one of your biggest competitors. You get very little say or control about what's written, on the Merkle proof, and you get kind of in a queue of work, right? So when we were building Fusion, we really took a lot of inspiration from Morpho, and I think Morpho is actually taking some inspiration from us in their V2, and I'll explain that a little bit at the end. But I like the idea that, I like this curator-led thing. One, because I don't belong to the cabal, right? You have these very old entrenched guys that are very connected to a lot of ETH wealth, and they can move around the money. But, this is not us. We're strong technologists. We're strong builders. But, it's been harder for us to get assets than some people that are connected to very large liquidity pools. So we also wanted to focus on risk curators because they come with unique strategies. They come with some of their own assets, and they also have different things to offer. They provide different risk-adjusted returns. So when we were looking at this, we started designing Fusion kind of at the beginning of the points craze and the LRT craze and all of that. And we said, okay, so we can build a levered product on points, but it will take us a long time. Let's focus on the core things that we want to improve about iPor. Let's focus on this asset management side. And so we gave the guys, the engineers, the team, a ridiculous problem to solve. And, I'm lucky to have such an amazing team. Otherwise, it wouldn't be possible. We got ridiculously intelligent and very talented people that are extremely intellectually honest and also very paranoid. And this is kind of what you want to have when you have people designing stuff on chain. So the basic challenge was, how can we build something that's modular, that's transparent, that's fully on chain, and automation first? And these are just buzzwords. They're kind of a too broad context, but what we came up with is iPor Fusion. And so how it works is basically, if we go to that issue with, like the Yearn v3 where you have to build new connectors, you can actually add and remove connectors using the diamond proxy pattern with these fuses. And you can actually change your strategy over time without ever touching the core of the vault, without ever needing to migrate the assets. And because the storage is also connected to the diamond proxy, that means that you can use a balance fuse and that the vault knows its own state in the market. Right? Take that versus some of the, I consider the others more trust me bro tech. Also some of these trust me bro tech can actually move the assets to an EOA, can do whatever they want with it. I want to know where my assets can go, right? So on the other side of the trust me bro tech, a lot of these share price calculations are done off chain, which is, I don't understand why. It's DeFi. DeFi tells you the state of your assets. So it uses this thing called balance fuses to keep the real-time state of the vault. The vault knows its own state. It's not omniscient, but it knows about itself. So that allows people to get to market quick. It's a trust minimized system. Fuses are superpowers. They allow you to construct anything that you can do with an EOA. Let's say, Max, if you build the Aave, let's say Aave v4 launches tomorrow, and let's say I build the fuse. You can use it as soon as I build it, as long as it's basically passed the governance checks and the security checks. And that means that our time to market is equal, and we have no replicated Solidity costs, Solidity developer costs. So that levels the playing field. It commoditizes integration, and it puts curators against each other, where before it was just the curators or, the protocols, anyone who could integrate a market got the assets. Now the integration is commoditized. It puts the onus on strategy, not only optimization, but risk management. So this allows you to get to market quickly, but it also allows depositors to see where their money can go. Right. So, for example, in a lot of the leverage looping vaults, let's take you through one a little bit later. You can see in the back end or at the vault level what's possible and what's not, what assets, what actions in which markets are whitelisted by the curator. So this is some transparency. This is transparency that's enforced on chain. And that's both your power to get to market, it's your automation first approach, and it's your security. So I would say that, Fusion really did kind of meet those design challenges, which was modularity, transparency, everything that can be done on chain should be done on chain, and automation first. So the other thing is, what I'm understanding is that not a lot of these other strategies are automated. It's just getting in, getting out, and not much even like risk management or optimization. Fusion has its own Python SDK where a curator they can automate anything inside of the vault that's written at the vault level. Let's say, Max, you set a strategy on your own Fusion vault. You give me the keys as this role, what we call the alpha, and I can automate on your behalf. You can get your depositors in there, but I can't take assets outside of what you wrote at the vault level. So again, this is automation, but it's also security. So you get kind of all of the traditional like fund administration things actually at the smart contract level and at the vault level. So all of these things thought through and how they go together, I believe is why we see a huge amount of inbound from different curators, and other curators are, referring new curators. So, I imagine it's because, they can get to market. And Fusion is fully permissionless. You can deploy a vault from the factory smart contract. You can wire it up on the front end. You can open it for depositors, and you never have to talk with anyone at iPor Labs.
So I do not have to be an established player in the curation space to just go on iPor and spin up a vault.
No, you can go to app.ipor.io/build-on-fusion, spin it up from the factory contract. You'll get a link to the front end. It takes some, it takes always takes a little bit to wire up the vault to get the display showing correctly. But yeah, you never have to talk with anyone.
Nice. So in terms of people who offer vault infrastructure, who would you say are the key players in the space beside you? And are these direct competitors, or are you all serving a different niche? Because from an allocator's perspective, I think it looks like everybody is doing vaults everywhere. And it is very hard to differentiate, okay, how is iPor different from, let's say, Upshift, or how is it different from Machina? And I understand that there are like in the intricacies when it comes to upgradability or like certain tail risks on the technical and like on the permission side, that there are significant differences. But like, is there anything on the front end or on the whole like deposit up to withdrawal process that the user experiences firsthand that differentiates these different providers?
Yeah, well, so I would say, the strongest players are the ones that right? So let's talk about three before we talk about kind of the difference with iPor and why I think Fusion is a clear lead for the long run. So everyone knows Veda, right? And Veda is, Veda, again, 7Cs behind. 7Cs was the main curator behind Sommelier.
Yeah, I
And Veda
still
really
remember the
grew.
Cotton Wars 2023 days and 2022 when Sommelier got announced. Easier times
Yeah,
back then.
yeah. And it has very similar construct, right? From the tech perspective. So Veda really grew with EtherFi, which grew with the LRT craze, which grew with points, which their main inflow was Pindle. So all of this like flow led to the behemoths that we have at EtherFi and Veda. They're very good teams, definitely, but on the LRT craze, because there was not much else interesting to do at the time, EtherFi was also able to get around the LST caps. So I look at market structure, I look at opportunities. Very good teams. Also, you have to be lucky, but also you have to be positioned in the right time. So 7Cs also, they built a reputation curating for Sommelier, and that's how they were in line to partner with EtherFi. But, you have murmurings, quite publicly, that there's a very big discrepancy against the APYs, that are published in public, and then what you actually get. And actually, if you look at the news site, you'll find that APYs are not shown, and also DeFi Llama. And I tend to ask simple questions, but other people may not want to ask questions, and other people may not want those questions to be asked. So, I'll leave it at that. But it's part of the Trust Me Bro tech. And yeah, they've also found a very good niche at doing these kind of pre-deposit vaults. And pre-deposit vaults, I mean, they're nice to bootstrap a chain, but I see a lot of the main organic activity flows back to mainnet. So, if you look at the way that fusion vaults can evolve, you can have a pre-deposit vault that evolves into a leveraged looping vault or something like that. And that's a very nice construct, right? The same thing with, Machina is a very, very talented team behind them, which is Dialectic. Dialectic, they've managed over 100 million on chain for the past 5 years. Very, very few people can say that, right? But again, you have these conflicts of interest, and these
Yeah, I
conflicts.
was wondering about that too when I first saw Machina launch, and I talked to some friends about it because I've known the Dialectic guys from, I think, the Denver 2025 days, and
Mhm.
like they told me about Machina back then, and I really liked the idea of it because I think the whole, like, being able to bootstrap your own vault from like an allocator's perspective and a manager's perspective is like, it makes the discrepancies between people who are, let's say, in the DeFi trenches day to day and discover these strategies versus the ones who are potentially still outside the industry with a lot of capital, and they wouldn't want to do the management themselves, and
Mhm.
not all the DeFi farming people would be able to provide a proper legal construct for a traditional fund structure, take in money, and then deploy it on chain. So these, like, yeah, smart contract based and code based vaults with very objective permissions and like criteria and configurations, these are an amazing solution in terms of just connecting capital to people who are able to generate returns.
And Dialectic, from multiple years of managing, I'm sure that they have a massive inventory of risk modules that are definitely a premium service that you don't want to spin up on your own, right? And so I think this is a clear advantage, but I think that the clear disadvantage is the conflict of interest between other asset managers, right? If you want to build your own business, it's going to be very difficult when you know that you have kind of the entrenched, manager there. And that's not only with just Veda and 7Cs, or Machina and Dialectic. It's Lagoon and Nine Summits and almost all the other guys, right? Where the iPor Labs team, we built tech, we build the interest rate derivatives. The iPor DAO does curate some very basic lending optimizer pools. The only reason that they do that is because it underpins the interest rate derivative pools. And again, that was the original construct of this. So you won't see the iPor DAO getting into a lot of like different yield strategies because it doesn't make sense. Our goal is to be this kind of prime brokerage infrastructure of DeFi. We want Fusion to be the BlackRock Aladdin of DeFi, where you'll have TradFi guys come in. If you're trading, you'll go into your interactive brokers account. You'll never go to the end markets, right? You need something that actually synthesizes the experience. But Fusion and its Fuse system actually does multiple things like that. It coordinates the markets. It makes the process of building seamless. It also standardizes the interface with the different markets to the Fusion vaults in the accounting system, where every credit market prices debt in a slightly different way. And Fusion and the Fuse system, it actually standardizes it into share prices on the Fusion vaults. So you also get standardization and aggregation on here, and that's a very difficult thing to do. And again, the vault accounts for itself. So, that's kind of inbuilt. So I think the permissionless element, all of the tools around it, from the front end, from the builder's interface to the SDK, will also be coming out with the CLI. So all of these things give you all the tools that you need to get to market. And my goal is that you never have to talk to anyone from iPor Labs. It's fully permissionless. We build out the most useful set of tools that everyone can get to market using the Fusion stack. And I hope that someday iPor Fusion or Fusion strategies live underneath like Web3 and Web2 wallets and exchange earn systems, but you never hear the term iPor or Fusion. It's just the underlying infrastructure that powers these yields.
Now, maybe on the note of measuring performance and verifying it, because I've found it interesting that you mentioned that in the past, especially respective of some historical events and yield farms throughout the restaking era. And I remember all of us in the DeFi dojo farming that very actively. How do you see that space evolve? Do you think that there is a specific need for an independent third party auditor or kind of a verifier who provides a performance dashboard? I mean, we've seen it, I think it's like either vaults.fyi or yields.fyi. I think it's associated with DeFi Dad. I think they build out something. And yeah, I mean, do you think the complexity of performance measurement is going to grow too? Because like in the past, let's say 6 to 12 months, usually the biggest discussion about, okay, is the yield actually matching the advertised returns, was around these concentrated liquidity vault type structures where you had very high advertised APRs because the range was very tight. But if you were to net it out after depositing into that thing for a few months, you were often even at a net capital loss because through rebalancing, so realizing the impermanent loss and making it from impermanent to permanent, you were giving up a lot of your principal. And now we've arrived at a stage in the vault space where if you look at certain projects, for example, Stream Protocol money, so that's Stream Finance, I would say that is on the more opaque side of things. I mean, like I have tons of respect for 0x Law. I know him personally, and I trust him to manage these funds exceptionally well. I think he's one of the best yield farmers out there. However, if you are on the side of, okay, I want to have total transparency around what people are doing with my funds, you might be scared away by the fact that you're not able to verify all of the strategies, verify all of the wallets, and be able to like verify what is advertised on the front end. And we've now moved beyond very simple lend aggregation or like concentrated liquidity vaults and have looping integrated with automated rebalancing across several protocols, across several strategies. So how do you see the verification and like bringing attestation to the advertised yields landscape evolve?
Yeah, I mean, verification can only be done after the fact for full transparent verification. And you see that in the share price. And you see it in the share price and realized when you're able to withdraw that amount. So that is the full verification, and the proof is in the pudding. If we go back to like 2020 fruit farms, you have the worst sins of the APYs shown, where you have the continuous compounding using the token's current spot price, regardless of slippage, and into the future, right? Or you can go the most conservative route, which is going off of the near term share price and extrapolate that. Or you can do something like an estimated, which is showing like some estimation of points, assuming that you get some like extra rewards. Maybe those are claimed and compounded, but those will always be forward looking and it will be different, right? And then the other thing is on leverage looping, you always have some cost. So for example, we had I think it was the Strata Vault. It's a leverage looping of the Strata PT position of SUSDE, right? And so this has all kinds of moving parts. The first one is it's a PT position, so that price moves all the time. You have the leverage looping, so you always have variability in the interest rates. Then you have the cost to enter the loop and the leverage. So, there's a couple of different features that you can have inside of Fusion as a curator, and those look very differently, if you're a depositor. So the thing that I think is probably the worst from a user experience perspective, but actually the best long term, is what we call onboarding contribution. And that looks very much like an onboarding fee to someone who's depositing. So far, we don't see anyone using this, but I would suggest that that curators use it, because what happens is there's always a cost to lever up. So, for example, let's say that I put in $100 and you put in $1 million after. My leverage cost on the $100 is is fixed. Your leverage cost on that $1 million is fixed, right?
Yeah.
But if I don't pay it so the onboarding contribution is socialized back to the pool. It doesn't go to the asset manager. So if I come in with $100 and you come in with $1 million a block later, and both of those are looped, mine is levered up and then yours is levered up, I'm going to eat the socialized costs of your loop if there's no onboarding contribution. So the early depositors eat the socialized leverage fees of the later depositors, and typically you have smaller depositors coming first, larger depositors coming later. If you have the onboarding fee, it socializes that cost back to the pool, so you don't get that negative share price calculation. But from the depositor's perspective, it looks like you're taking a fee, which is really not. It's covering the cost of leverage. Also, we have that on the withdraw optional. As a curator, all of this is optional. You can set it up as you please, and that's your unwinding cost, right? So there's always a cost to unwinding. You have to take a flash loan and you have to exit the position. So there's always a cost. You have to go through DEXs, and this is just the name of the game. But, if you're not deep in the weeds, I assume most DeFi dojo people know this, but, if you're not deep in the weeds, say, what's this cost? And is the curator making it? No, it's going back to the pool. It's going to socialize this cost of leveraging. And because there's a cost of leveraging, you probably should stay in a leverage position. It's not like, if it's showing, 20% that, after the first month, you're going to realize 1/12 of that, because you're going to have some cost to get in. So you always have to be able to recoup that in some way. So I can't remember how this stream, this part started. Were we talking about fees or use?
Yeah, we were talking about the performance attestation, but on the note of like having no explicitly stated exit and entry costs, I think that in retrospect was a very big unlock to just making DeFi yields and especially vaults more accessible to people, because I think one variable that so many people missed in stablecoin farming is just the ongoing operating costs you've had in the past when ETH L1 gas fees were like extraordinarily more expensive than they are now. And you had all of these swap fees. And now you have a lot of vaults where it's just USDC in, USDC out. From a depositor's perspective, it is super comfortable because I would rather be willing to take a bit of a lower yield in exchange for certainty that I do not face any costs before or after the fact of depositing into this vault, which I was not able to see beforehand. So yeah,
And
I
this is
think
also
that's
kind of tax optimized, because you enter with an asset, you get a share price, and you exit, and then you can calculate the gains on that very simply. So I think that's also easier. It has an advantage for that reason as well.
Yeah, I think that's like the tax considerations are another very, let's say, bullish catalyst for vault infrastructure, because I'm based in Germany, and if you are holding crypto here and everything is taxed on a transaction basis, like good luck and have fun explaining to some countryside IRS equivalent what a Pendle YT is structured like. And if your airdrop that you receive 6 months down the road after expiry of said YT is going to count as income, capital gains, or whatnot, is extraordinarily difficult. And if you're in a vault, you can just say, I mean, even by now, there are Euro C vaults out there. You can just put your euro in, you take your euro out, whatever is left after that is going to get taxed, and the positive difference of such. So that makes things, I think, a lot easier. And personally, I'm very confident, especially after seeing what's been going on at Token 2049 in Singapore 3 weeks ago and last week at DAS London. I mean, everybody is moving towards the vault space. So it's like a total vaultification of DeFi. And I think it's going to become particularly interesting when the TradFi players are entering the game. Maybe on that note, just a weird side question, but have any prominently like TradFi known funds or hedge funds approached you guys to launch a vault on iPor, or have you seen any appetite from non-crypto native players to start dabbling in DeFi via vaults?
We have some dabblers. We have some well-known kind of crypto institutionals that are either doing some private strategies or looking to our strategies, or also deploying into some of the public ones. So this is something where we're looking at it as, kind of extra distribution. And yeah, but there's also some other, I mean, you guys know some of the more traditional kind of asset managers, wealth managers that are much more interested in DeFi. One of the big hurdles that I got, and especially came up in London, is what are the KYC considerations? If you're using client funds, KYC at the vault level, KYC at the market level. So you're always going to get this from regulated finance, but if you're deploying from your own balance sheet, it's kind of a different beast. So we're talking with some very interesting players behind the scenes, and maybe some people from those organizations are already using Fusion. We've had a lot of discussions behind the scenes, and yeah, I mean, this is why I mentioned this kind of BlackRock Aladdin, like this prime brokerage protocol of DeFi. I'm not really, it's extremely useful for DeFi natives. But one of the reasons DeFi natives are using vaults is because they find that, maybe they can't outperform the market, and maybe it's better, to give some fees to someone professional so that they can actually go out and touch grass. And, I'll be honest, I'm one of those people, except, I am building the whole time. But if I were able to step away from the computer, this is, kind of Fusion is a product for people like me. I have the very, very strong need, where I don't want to be eternally online, to manage funds. And let's take October 10th, right? So October 10th, the Fusion Vault survived quite well. No bad debt, no liquidations. And it's exactly because of this automation. So when I say that, we've got feedback from others that say, a lot of these guys talk automation, but there's no automation, this is quite scary. So can I share my screen really quick? I can maybe walk you through like Fusion, like what it looks like from the asset allocator's perspective, and also then kind of behind the scenes. So for example, if we look at this, about 360 million under management. This is in leverage. So we see Reservoir is actually really dominating this. A lot of people in the dojo know about Reservoir protocol. So this is a fairly simple strategy, that you can do with your own wallet. But at a vault level, it's a bit more complex. And this is where Fusion really shines, and especially on the automation side. So this has been a hugely popular strategy. So for example, it's almost got about 4,000 ETH in, levered up to 24,000, right? So people look at this and say, that's pretty degen, that's irresponsible, but they don't look underneath. It's actually fairly fundamental. It's fairly straightforward. And Fusion is a very good place to do it. So for example, let's look at this. This is the share price versus the APY one day, which has what's the spot APY after fees, also including this little kind of assumption for token incentives and morpho assumptions, and after fees. So this is the idea of transparency, but this is forward looking with some different assumptions where you can get the verification, in the actual share price, which has some volatility, due to, I think it's mostly, Reservoir printing their yields kind of once a day. This is why you always get this kind of like decay. So what this is it's actually very simple, right? You take ETH, you collateralize it on Aave. You're earning 1.93% on that. So that's part of your yield. You're borrowing and you're paying 5.64% on the APY, right? So there's one of your debt costs. And then you're leverage looping it for SR, and USDC. Right? And this is where you get the majority of your yield. Of course, it's capped to the loan to value. So in an automation scenario, and this is something that Reservoir has set, and actually iPor Labs is automating for them as a role of the alpha, is what's your loan to value and what are your bandwidth between ETH and the borrow, right? Let's say ETH rips, then you want to probably lever up. So if the loan to value drops, then you can lever up and get more juice. If ETH drops, you actually want to unwind the loop to pay back the debt. And every once in a while, you want to take back some of the realized gains and actually buy ETH and put it into Aave. So all of this is automated. So I'll give you a kind of a little, trick. So you can do /edit behind any Fusion Vault, and you can get into the back end. So this is Reservoir's. This is the management interface. But this is everyone can see it. It's transparent. So think of it like if we're running a kitchen, this is the recipe, but the secret sauce is back in the kitchen, right? So we see that this has a 5,200 ETH cap. We can see that it's already been converted to public, but if it wasn't, it could be whitelisted with a certain set of depositors. Shares are transferable. We can see who can do what. I won't get too much into the details, but Atomist and Alpha are the main roles. Atomist can kind of set the rules that allow you to do everything here. And the Alpha is the automator. So here's the Reservoir Protocol. Here is the iPor Labs Alpha. And that is the automation. So again, you can give me the keys, but I can only go within your bounds. So you can add, let's say we wanted to add Euler to this, and we can add lend and borrow, and we can go update, right? You can bundle fuses and attach them to the vault using that diamond proxy, and you never have to have people migrate their token, migrate their assets, and never upgrade the vault. So that would also install the balance fuses. So we look at the fuses. We see this vault has AVV3 supply fuse, borrow fuse, Morpho flash loan, collateral, and Morpho borrow fuse, right? And universal token swapper. These are the ingredients for flash loans, right? We don't see Euler here. We don't see fluid here. So we know assets can't flow there. So these are your connectors. These are your on-chain gates. These allow you to connect, basically do, everything that you need to do leverage loop, for example. And they're all attached to the vault so that everyone can see what's possible and what's not. As I said, the balance fuses, they allow the vault to account for itself, and Morpho V2 definitely uses balance fuses, maybe a little inspiration from Fusion, which is cool because we definitely take inspiration from some of the best teams in designing our own stuff. So the substrate shows you what the vault can interact with: wrapped ETH, SRUSD, USDC. You can see on the Morpho Flash loan which assets can be used, which Morpho market. Only this one is whitelisted. You can add to the substrate. In the token swapper, which can be used, and also the ERC20 balances. So this is the back end. And then you can see here on the fee side, this has, this is where the Fusion DAO actually earns money, 0.3% on management, 2% on performance, and the asset manager can set the rest. Price oracles, you can set custom price oracles, you have a whole range of pre-hooks, and all of that goes into this kind of transparent vault view where you can see what's going on, where's my money, where's the yield coming from, and who can do what. So we want to give everyone the tools to be able to analyze, and this is why Fusion is kind of your permissionless infrastructure. If you go to after iPor this build on Fusion, here you can set a vault, you can set it up on Ethereum, Arbitrum. Oh, look at this. You have Plasma, you have Avalanche, you have Ink. Maybe that's some, alpha for you, but you can also create a Fusion vault wrapper. Let's say
there going to be an Ink airdrop for iPor users?
Let's see what happens there. So, if you want to create a Fusion vault wrapper, let's say that you have Harvest Finance that's doing these autopilot vaults, and they're mostly on base. So let's say we want to go on base, we want to add the Fusion vault address for the Harvest autopilot. You can wrap that, you can pass it on, let's say as Odyssey USDC. You can take a small fee at the interim vault level and right on top of Harvest. So this is where a wallet can wrap any of the strategies on Fusion. You can also create a new price feed with a dual reference. You can do it from a Morpho price feed, or you can do it from a PT price feed. All of these tools are open, they're public, you can use them, and then you can go into the repository. Let's see. You see iPor Fusion. Oh, I see Abisu Finance Zapper on board, which was just merged. But iPor Fusion has, this is the kind of core contracts. And then you also have a Python SDK in here. Actually, you have a couple things. You have Python SDK. You also have something called Dope, which is a whole quant backtesting toolkit that you can plug into multiple sources to basically backtest strategies, or you can use the iPor Fusion Python SDK to automate your strategies. So what that means is that you get kind of everything that you need to build your strategies without ever having to talk to anyone from iPor Labs. Of course, we're always here, to help.
Yeah, that looks pretty cool. I mean, I'm very tempted to spin up a vault, maybe around the later part of the year. Maybe of the current vaults available on Fusion, is there anyone in particular that stands out to you, which you personally find super interesting or which you are personally invested in? And maybe on the other side, have there been any vaults so far that have been underperforming the advertised yield? And are you guys as iPor, if that happens, opinionated in any way and like try to remove these vaults or like help the distribution of other vaults which are either over or underperforming?
Yeah, so we definitely do. We want the best, the best shown to the market. So it is permissionless, but there is some curation on the front end. So for example, there's a toggle that's right now hiding any vault with negative yield. Also, because it takes us some a little bit to wire up the front end. If you come with an extremely risky strategy or one that is has unverified fuses, which is, let's say, move funds to someone else's pocket. This is quite problematic, and we're definitely not going to display it, right? But it will be on chain, it will be open, it will be permissionless. From a favoritism perspective, I I was supposed to be, like neutral, so I won't go too far into it. But there's some really cool strategies. So the leverage looping strategies is the favorite of the market for sure. High yields. The lowest risk strategies are the lending optimizers, and really on there you see the iPor DAO just in the lending optimizers that underpin the derivatives pools, and you have the harvest autopilots, and those are kind of your low risk. And then kind of one like very interesting middle ground one, which is it's neither leverage nor lending optimizer. It's this kind of Tau bond ETF, which is it's just taking long dated, not really long dated, it's taking PT positions. And it's getting a very nice risk adjusted return, given the state of the market right now. We had a lot of leverage flushed out, I think, in October 10th. The Athena rate has dropped, so a lot of people have kind of unwound. But that means there's also kind of cheap credit available in the market. So you can find something for everyone. And then, of course, I think that the Syrup USDC one is going to be extremely popular. And I guess, now that we're talking, there is a points program that's dropping right now. I don't know whether it will be announced today or tomorrow, but you can go on the app and see it. There's a referral program, and yeah, but all of our growth to this date has been fully organic, and that's been a very nice thing because it's more that the market is adopting useful tools, transparency, and also the stack that can execute on these sophisticated strategies. Because I think our number one calling card is DeFi Llama. The risk adjusted strategies that people are building on Fusion through the automation is quite nice. You can go up the risk curve, either on leverage or something else, by yourself, pay the gas fees, do this, or you can sit back, relax, and, have kind of the curated experience. So even though we've grown fully organically, now it's time to throw some gasoline on the fire, let this burn quite brighter. You'll have the Syrup USDC leverage looping vault coming up, and that's quite nice. Fusion has semi-exclusive distribution on that. What that means is that the vault has the permission to mint and redeem. So that means minimized leverage costs, especially unless there's the kind of the PT version there, and it's actually one of the only places where you'll get Syrup rewards apart from the Maple front end. So this is going to be the place where if you want to get into this, in size, it's probably going to be one of the Fusion vaults are going to be your kind of place to do it. And this means you can flash loan between Aave, between Morpho, and also the Morpho PT versions, and that's where you can actually take this capital allocation and optimize it in case the basis inverts in one place. You can flash loan to the other, but actually you don't have to do anything. This is the infrastructure that's taking care of it for you. And we have Vault risk rating. I think one of the first of its kind by Cerberus, which they do risk ratings on crypto assets and also now vaults. And that I think they did one on their social recently. So I think this vault is one of the first in the industry to get a risk rating. And it's nice because it shows the entire flow of funds on the vault, on the vault, on the report. You also get Monte Carlo simulations of the risk that you're taking, given the leverage parameters, running multiple scenarios. And so that's really cool. So again, we provide infrastructure that people can build around, like strategies on top of Syrup USDC with MEV capital, risk rated by, the Cerberus. And so this, I think, is the future of DeFi. Again, providing all the transparency. But this is why I say, this is like the prime brokerage protocol of DeFi.
Very nice. I think we've covered the whole bandwidth in this conversation, from the origins of iPor up to the upcoming and ongoing points program and potentially an upcoming token launch. Are there any other topics that we haven't covered yet, Darren, which you'd like to dive deeper into?
I think not. I think that you don't want to hear me for much longer. For sure.
Yeah, I think we've covered it all. Great insights. And thanks a ton for joining. I'd say I'm like obviously not financial advice as anything said on this podcast, but like I'm personally been a user of iPor in the past and still deposited in maybe one of the vaults or the other. And yeah, personally very much like your guys' protocol. And I think there are very bright times ahead in the Vault Infra curator and allocator space. So thanks again for coming on, Darren. Where can people find you? Where can people find iPor, and which links should we include in the podcast description?
Yeah, definitely app.ipor.io/fusion. That's the main. All the docs at docs.ipor.io. The GitHub of iPor Labs, has all the fun goodies. There's a research that was a little bit outdated. We did a lot of quant research on, different interest rate things in DeFi. Main account is on X is iPor_IO. And I think that about covers it. So yeah, there's a ton of information. There's links to the Discord on ipor.io. And there's we have a very nice community inside of there. So ask any questions. Also, the curators have dedicated channels inside there. If you have any questions about a specific strat, you can ask there or get support. Or we have now people coming in asking about, how to integrate some of the pools as they're part of their earn programs, or other people asking how they can build on Fusion. So that kind of covers it.
Very nice. Thanks again for coming on. It was an absolute pleasure. And yeah, see you again in the future.
Thanks, Max.